all the proposals that were in the budget speech. Of course, yes, it'll be interesting to see what comes through in the draft legislation later on this year. But what we have seen over the last couple of years is legislation that is promulgated and has an effective date sometimes 2 years hence. For example, with your changes to the retirement system, we saw those changes coming through in 2013, effective 1st of March 2015. So as much as we go through those changes, we sort of go through it thinking, well, will we still remember all this stuff in 2 years' time when it actually becomes effective? And another example is the changes to the medical expenses, the tax relief on medical expenses, which came through the sort of latest batch was in 2012, but effective 1st of March 2014. And so what we're going to do is just spend some time, because these changes came through 2 years ago but are now effective. I think it's opportune to re-examine these changes and just make sure we're up to speed with exactly what's involved here. Now, we've seen over the last few years a shift in the way that the tax relief is given for medical expenditure. Some people would argue that there should be no tax relief for medical expenditure because it's private expenditure, etc., etc. But the issue is that it has been a feature of our tax policy for many years. And going back, we used to take all of our tax reliefs through the Section 18 tax deduction. Remember that? And then we started seeing a change where there was a bit of a pullback on the 18 deduction, and we started moving towards a tax credit system. So for the last few years, we've had a combination tax credit and tax deduction system, certainly for people under the age of 65. People over the age of 65 have kept going with the tax deduction system all the way through to the end of February 2014. But now we see another substantial change from the 1st of March 2014. And we've seen that Section 18 is now, has now disappeared. It's a bit like saying goodbye to an old friend, I think, because for many of us, Section 18 has been a dear part of the Income Tax Act for many years. But anyway, it's now gone. If you look at your tax legislation, you try and look up Section 18, I think you'll find 3 little dots there with something in brackets below saying it disappeared with effect from the 1st of March 2014. Most of the provisions, though, from Section 18 have been transported down to this new Section 6B. So those are all the provisions explaining what is qualifying medical expenditure, what is a dependent, etc. So all those definitions have simply been transported down. So the concept of relief for your qualifying medical expenses, etc., is still there, but the form that the relief takes is it's no longer in the form of a tax deduction. You now work out what you would have got for your tax deduction, multiply the amount by a certain percentage, and that becomes an additional credit. So no more tax deduction from the 1st of March 2014. Instead, we've now got 2 credits that come in, Section 6A with our medical scheme fees tax credit, and Section 6B with our additional medical expenses tax credit. So 6A we've become pretty familiar with over the last few years. That is the credit that comes through on a month-by-month basis. You can take it into account through the payroll. Where a person is a member of a medical aid, we get the credit that's calculated, the new rate from the 1st of March 2014, we saw this earlier, 257 Rand per person for the member and the first dependent, 172 per person for each additional dependent. So that credit still operates exactly as it has in the past, except that it even operates now for people over the age of 65. All right, whereas up until the end of February, people over the age of 65 were still using the tax deduction system. Now everybody moves on to the dual credit system. All right, so the 6A credit, as I say, that stays pretty much the same as we've had it. 6B is really the new credit that's come in. And that's, as I say, effectively taken Section 18, converted it into a credit. All those provisions from Section 18 have carried through. So if we look at the concept of this additional credit, it's a credit for additional medical expenses. And when we talk about additional medical expenses, it's your excess medical aid contributions. You'll remember that term from the old Section 18 deduction. And it's also your additional qualifying medical expenses. So when we talk about excess medical contributions, it's the total amount of your contributions. Just have a look at the next slide here. It's your total contributions for people over the age of 65 or people with a disability, minus 3 times the amount of their medical scheme fees tax credit. So your 6A credit, 6B credit. When you're working out your 6B credit, you take your medical aid contributions minus 3 times your 6A credit. That's your fixed monthly credit. Obviously, you would work out your 6B credit at the end of the year on assessment. Okay, if a person's under the age of 65, then you work out your excess medical contributions, pretty much the same as what we have been doing, medical scheme contributions minus 4 times the amount of the medical credit. Okay, so that's determining your excess medical aid contributions. Then back to the slide over here, we then also take into account qualifying medical expenses. Now, qualifying medical expenses is the same definition as we used to have in Section 18. So it's your doctor's fees, it's your hospital accounts, it's your prescribed medication, and it's your disability expenditure. So all of those things that fitted into the definition of qualifying medical expenses comes into this new definition in Section 6B. Remember also that when we talk about qualifying medical expenses, it's expenses that are not recoverable. So it's your out-of-pocket expenses. So if you've paid, a certain amount, recovered it from medical aid, that is not qualifying medical expenses. Once you get beyond your medical aid limit and you're starting to pay things yourself, then that is qualifying medical expenses. Then, of course, if you're not a member of a medical aid, then you won't be looking at medical contributions at all, and then of course your qualifying medical expenses is probably a little bit higher. There's another discussion that one could have around, well, what if you have insurance for dread disease, etc., and you get a payout, and to what extent is that regarded as a recovery of your medical expenses? You'd have to deal with that on a case-by-case basis, because you'd have to see what is the connection between the payout on the insurance and actual medical expenses incurred. But at the end of the day, qualifying medical expenses, the Act simply says it's expenses which are not recoverable, incurred on doctors, hospitals, etc., etc. Okay, so if you're a person over the age of 65 or you're under 65 but yourself, spouse, or one of your children is a person with a disability, then basically your percentage is that you take the amount that would probably have been a deduction and multiply that by 33.3% to get the amount of your credit. And if you're a person under the age of 65, then you go through the same sort of calculation that you would have done for Section 18. So you take your excess medical contributions plus qualifying medical expenses, add that together, subtract your 7.5% of taxable income, that's your sort of hurdle rate. Remember, you used to deduct that excess. Now you take the excess, multiply it by 25%, and that becomes your second credit. All right, so it's not too dissimilar to what we used to do under Section 18, but the key thing is that, of course, you don't get the Section 18 deduction, you get a percentage of that amount as a credit. Now, if we're saying that a person is getting the credit of 25%, whereas previously if they claimed a tax deduction they would have saved 40% tax on every rand of deduction, then obviously that person's going to be worse off under the system. So it's safe to say anybody with a tax rate above 25% is going to be paying more tax this next year. All right? Anyone with a tax rate, if you're lucky enough to have a tax rate less than 25%, then you'd be paying less tax this year. So if you're on the 18 or 25%, 25% would be the same, 18% you'd be paying slightly less tax. All right. Just to look at an example of how this will all work. So if we take a person under the age of 65, there's no person with a disability in the family, and the employer is paying the medical aid contributions. So if you think about the current scenario, you would take the person's salary, you would add on the employer contributions as a fringe benefit, so there I'm adding it on over there, and you would deduct the person's contributions to pension. Of course, up until the end of February 2014, you would have also deducted Section 18 medical deduction. But now you'll see there's no Section 18 medical deduction, that falls away. Instead, what you see is this calculation of the additional medical credit down here. We'll come to that in a moment. So once we've worked out the person's taxable income, then we obviously look that up on the table, take off your rebates, and then you take off your medical scheme fees tax credit, the Section 6A credit. That monthly credit times by number of dependents, etc., multiplied by however many months in the year. In this case, I've got member, 3 dependents over 12 months, and I get to a credit of 10,296. So up until there, pretty much the same as before. As I say, the only difference being that you haven't got your Section 18 deduction. Now we get to the second credit. We work out this credit by taking your actual medical aid contributions during the year minus 4 times that medical credit. So 4 times your Section 6A credit. So 10,296 times 4 gives me 41,184. We subtract that from our actual contributions to come to excess contributions of 30,816. So again, very similar to what you would have done under the old Section 18. And also very similar, add on other medical expenses, that's your other qualifying medical expenses, we add that on, and then you subtract 7.5% of taxable income. So same methodology at this stage. But now the change comes through is that this amount of 13,191, instead of claiming that as a tax deduction, which we would previously have done up here, now we multiply that by 25% and that becomes your second credit. All right, so not too much of a mind shift. The thing is that it's the same kind of methodology to work out what is the amount that is subject to the credit, and then once you've worked that amount out, then you multiply that by 25% and that becomes your second credit. Of course, the issue is that on a month-by-month basis, for this particular person who's earning a salary and the employer is contributing to the medical aid, the employer through the payroll would take into account the Section 6A credit each month, as they've done before. And then on submission of the tax return at the end of the day, you would take into account your Section 6B credit. So this person would get a small tax refund based on the amount of the 6B credit. Okay. If we look at somebody over the age of 65, and here there's probably a little bit more of a mind shift, because over 65s we're still claiming the Section 18 deduction up to the end of February 2014. And remember that the over 65s would have claimed the full amount of all of their medical expenditure. They didn't have to worry about that 7.5% hurdle rate. Now, what will happen is that people over the age of 65, let's assume this person is earning a pension and there's tax per the tables minus his primary and secondary rebate. Oh, I have fixed up this number here, by the way. I think you've got a 50-something thousand there, which someone pointed out to me the other day wasn't right. So see, people are sitting in the audience with their calculators, checking my calculations as we go through. All right, so I did recalculate. That should be 79147. Okay, and then you take off your primary and your secondary rebates. And then, of course, your medical scheme fees tax credit. So I'm assuming here I've got the member, and he's paying contributions for himself and his wife. So it's the member and the first dependent. 257 times 2 over 12 months gives me my 6168. Again, this could be taken into account every month through the payroll system when the pension is paid out to him. Then the additional medical credit that comes through here, this one you would calculate by taking your medical aid contributions. I'm assuming he's paying 2,000 Rand a month. I mean, I'm sure that's a ridiculously low figure, but we'll just work with the numbers for now. 2,000 Rand a month minus 3 times the medical credit. So 3 times 6168 gives you 18,504. So that gives you excess contributions of 5,496. Now, the way that the calculation is done in the explanatory memorandum was that they then take the excess contributions times 33,3 to come out with that part of the credit. And then they work out the credit on the qualifying medical expenses. 20,000 times 33,3 gives you 6,660. Add those two amounts together and that comes out at your 6B credit. Of course, you would achieve the same result if you took your excess contributions of 5,496, added on your qualifying medical expenses of 20,000, took the total times 33,3%, come out with the same number. That your second credit, your 6B credit, is 8,490. All right. So that's effectively your over 65s, and what will happen is that people that have a person with a disability, so if the taxpayer's spouse or any of the children is a person with a disability, then it would be virtually the same calculation as we had for the person over 65. In this case, I'm assuming that we've got a single parent, 2 children, one of the children is a person with a disability. The parent has taxable income of 400,000, work out tax per the tables, take off the rebate, under 65 rebate, that's the new rebate over there. Take out the monthly medical scheme fees tax credit. So it's 257 times 2 plus 172 over 12 months gives me 8232. And then to work out my additional credit, I take my medical aid contributions, actual contributions paid during the year. Of course, that could include if the employer had paid the contributions, that would come in here as well. Minus 3 times the medical credit gives you your excess contributions times 33.3%. And then qualifying medical expenses, 40,000 times 33.3%. So my total Section 6B credit, 29072. Taking my normal tax liability down to 45244. So again, this person would probably have your medical scheme fees tax credit processed through the payroll every month, and then on assessment, the person would get the refund relating to this additional credit. And obviously, in order to pay out that refund, SARS is going to go through the same type of verification process that you currently see for Section 18. So you would expect the same proof of expenditure, etc., etc. Okay. Just a point, people often ask me, well, what happens if a person is not a member of the medical aid? Well, let's just go back to this, just for probably more general reference. Let's go back to this calculation with somebody under the age of 65. And let's assume that this person was not a member of the medical aid. All right? Then obviously they wouldn't be paying, or the employer wouldn't be paying contributions to the medical aid, but assume that instead it meant that their cash salary went up to 600,000. And they decided they're going to self-fund their medical expenditure. So assuming still taxable income of 555,000, still tax per the tables minus the rebate, you simply wouldn't get the 6A credit. That would fall away because the person is not a member of a medical aid. When you look at the Section 6B credit, there'd be no medical contribution, there'd be 0 over here. So this part of the calculation would fall out of the picture. It wouldn't be relevant at all. And then you would take your other medical expenses. Supposedly your other medical expenses would be higher because you've had to self-fund. Let's just work with 24,000 for now, just for argument's sake. If this person had spent 24,000 on other medical expenses, minus 7.5% of taxable income, no tax benefit. But of course, if we're really going to compare like with like, we would say, well, they're not a member of a medical aid, they've picked up their own medical expenses, but let's assume that it comes out at more or less the same amount. All right, so let's just assume for argument's sake that their other medical expenses came to sort of 54,000 rand. Then what you would do is you'd say 54,816 for argument's sake, minus 7.5% of taxable income, and you would then follow that through and do that calculation. So it all depends, you know, if people say, well, are people going to be better off or worse off, you know, if they're on medical aid versus not medical aid? It shouldn't actually make any difference. But again, it's going to come back on a case-by-case basis, because it depends at the end of the day how much you spend on medical expenses. All right. And if you're under 65, you're not going to get any tax relief until you start spending more than 7.5% of your taxable income, and then it's still tax relief on the excess. Yes? Yes, so the question is the medical aid contribution over here inclusive of the employer's contribution. In this particular example, I'm assuming that the employer pays all the contribution, so it would, and even if they weren't, yes, your medical aid contribution over here would include the employer's contribution. So let's say you took an example where the employee is paying half and the employer is paying half. Then what would happen is whatever the employer is paying would come in as a fringe benefit over there, and that would then be a contribution deemed to be paid by the employee. So then you would, at this part of the calculation, it would be the person's own contribution plus what was contributed by the employer would carry through, yeah. Any other questions? All right, so it is going to change the sort of tax calculation quite substantially, I think, going forward, especially if people have tax rates of, say, 40% as opposed to the tax relief now being at 25%. So it's probably a good idea when you're going through this filing season that's coming up. You're going to be doing the 2014 calculations. Might just be a useful exercise for you to give an indication to your clients of what 2015 is likely to look like with these new calculations. Then at least you don't get a nasty phone call next year when they're suddenly having to pay more tax and they think you've done something wrong. It's actually just because of the legislation. And at least if you can warn them about it, then it avoids any nasty surprises. All right, so it's probably a good idea just to do that estimate just to see how it is going going to impact on people, especially your high income earners. They're the ones that are going to be paying quite a lot more tax through this new system. But of course, if people have never claimed a tax deduction because they never had expenses more than 7.5% of taxable income, it's probably not really going to make that much difference to them. Okay. Right.